What role do option Greeks play in trade adjustment decisions? Imagine trying to steer a ship through choppy waters without a compass. That's what trading can feel like without understanding the option Greeks. These tools are like your navigational aids, guiding you on how to adjust your positions when the market shifts. Each Greek measures a different aspect of risk, helping you see what's happening beneath the surface of your options trades. Delta is the first to consider. It tells you how much your options price is expected to change if the underlying stock moves by $1. Think of delta as your directional indicator. If your delta gets too high or low, it means your position is becoming more bullish or bearish than you want. You might then decide to buy or sell options to bring your delta back to a comfortable level. This keeps your risk aligned with your market outlook. Gamma is next. It measures how quickly delta changes as the stock price moves. If gamma is high, delta can shift rapidly, making your risk profile unpredictable. This is especially important when the stock price is near your strike price. If gamma is large, you might want to adjust your position early to avoid sudden surprises. For example, you could close or roll your options to reduce this risk. Theta is about time. It shows how much value your options lose each day as expiration approaches. If you hold long options, Theta can eat into your profits. To manage this, you might choose to close positions that are losing value or adjust by selling options to collect premium. Conversely, if you want to benefit from time decay, you might sell options with high theta. Vega measures how sensitive your options are to changes in implied volatility. When volatility rises, options tend to become more expensive, and when it drops, they lose value. If you expect volatility to decrease, you might want to reduce your long Vega exposure by closing or rolling options. On the other hand, if you think volatility will increase, you could adjust your positions to benefit from that move. Rho is less common but still relevant. It gauges how much your options value changes with interest rate shifts. For longer-term options, changes in interest rates can impact prices. If rates are expected to rise, you might adjust your positions accordingly to avoid unexpected losses. All these Greeks work together to inform your trade adjustments. If delta gets too high, you might roll your options to different strikes or expirations. If gamma is large, you could close or modify your position to avoid sudden risk spikes. If theta is eating into your profits, you might hedge or close options to limit losses. If volatility is changing, you can adjust Vega exposure to protect or profit from those moves. Monitoring these Greeks constantly helps you stay on top of your risk and keep your trades aligned with your market view. It's like having a dashboard that shows you where your risks are building up and what actions to take. This approach makes your trade management more precise and helps you stay calm and confident, even when the market gets unpredictable. Using the Greeks as your guide ensures you're making informed decisions that keep your risk in check and your profits within reach.